Welcome back to Investing Talk Podcast. We're here to cut through the noise and transform complex information into clear, actionable insights for you. Today, we're focusing our attention on a tech giant that's, well, rarely out of the headlines. We're asking a question on many investors' minds. Is Alphabet a good time to buy now? We've pulled together all the latest data, recent earnings reports, pivotal legal rulings, technical analysis, future projections, you name it. The goal is to give you a comprehensive understanding of Alphabet's current standing and outlook. Before we jump in, if you're finding value in our discussions, please do hit that subscribe button, give us a like, maybe leave a comment. And hey, if there's a specific company you'd like us to look into, let us know in the comments below.
Yeah, and what's fascinating about Alphabet right now is just how quickly the landscape can shift for a company of this, immense scale. We've seen a confluence of significant events recently that have truly reshaped the narrative around its future. Makes this a particularly timely analysis.
Okay, let's unpack this then. For a company known for, groundbreaking AI and innovative products, the biggest news recently actually came from a courtroom, not a lab. What exactly happened with that legal decision? Why was it such a game changer? It seems like it de-risked a huge part of their business model.
You're absolutely right. That legal outcome was, well, monumental. In late August 2025, U.S. District Judge Amit Mehta ruled that Google's search business had violated antitrust laws. But, and this is the crucial part for investors, the ruling avoided structural penalties.
Meaning no forced breakup.
Exactly. No mandated sale of core assets like the Chrome browser, the Android operating system. Many analysts, investors, they feared those more drastic measures that would have fundamentally reshaped Alphabet.
Right.
Instead, the court mostly imposed what they call behavioral remedies.
Okay, behavioral remedies. Like what?
Things like mandatory data sharing with competitors, ending some of those exclusive search deals they had.
So, okay, on the surface, it looks like they dodged the biggest bullet. That crucial, $20 billion annual partnership with Apple that stays intact.
That stays intact, yes.
Yeah.
That was a key detail.
Are we maybe underestimating the long-term impact of these behavioral things? Mandatory data sharing, ending exclusive deals? Couldn't that still chip away at their dominance, just maybe more slowly?
That's a perceptive question, and it's definitely a nuance to watch. While the structural breakup was let's call it the existential threat everyone worried about, the market's immediate reaction suggests the relief from that threat far outweighed the potential friction from the behavioral ones. I mean, look at the stock. Following the ruling on September 2nd, it surged over 8% in after hours.
Wow.
Then September 3rd, climbed another 8%, hit a new all-time high.
Just like that.
Yeah, and put it in perspective. The stock was already up nearly 20% year-to-date and about 50% since April. So analysts, they quickly reevaluated. You saw Bank of America maintaining a buy, bumping their price target up to around $252. They basically saw this as a major clearing event, a best-case scenario even.
Right. It removed that huge existential risk cloud hanging over the business model.
Precisely. But a note of caution here.
Okay.
While it's positive, the stock had already surged, over 35% in just one quarter before the final ruling?
That's a big run-up.
It is, and that kind of rapid ascent can definitely set the stage for some short-term volatility.
So a bit like a runner who just sprinted a marathon. Impressive performance navigating that legal hurdle, but might need a moment to catch their breath before the next leg, even if the finish line looks promising.
That's a great analogy. The removal of that uncertainty was a huge boost to confidence, especially institutional confidence. But yeah, the market needs time to digest those rapid gains, maybe reestablish a stable base.
Okay, so the market breathed a huge sigh of relief legally. That major overhang is reduced. But, a clean legal slate doesn't automatically mean robust, growing business. Now that we've covered the headlines, let's dig into the bedrock. Alphabet's financial fundamentals. Are they as strong as that stock surge suggests?
Absolutely. And looking beyond those headlines, Alphabet's financials continue to show impressive underlying strength. For Q2 2025, they reported revenue of $96.43 billion. That wasn't just meeting expectations, it exceeded consensus.
Solid.
Very solid. Total income from operations hit $33.1 billion, up nicely from $29.7 billion in Q2 2024. A big driver is still Google Services, the ad powerhouse, but importantly, we're seeing improving profitability in Google Cloud.
Cloud. That's key.
Definitely. It posted, $2.83 billion in operating income for Q2. That's healthy progress.
What about those other bets, though? We always hear about them, Waymo, Verily. They seem like a perennial drain on the balance sheet. Still the case. Should investors worry?
You're right to point that out. Other bets did lose about $1.25 billion in Q2 2025, but it's crucial to see these less as a drag, more as Alphabet's strategic long game. These are the moonshots, right?
Right, the potential future Googles.
Exactly, potential future revenue streams. Think Waymo with autonomous vehicles, Verily in life sciences. Expensive now, yes, but they're absolutely essential for securing dominance in emerging tech sectors down the road. It's a calculated burn rate for future innovation. It shows their long-term vision.
And for a company with their cash flow.
It's manageable. It's an investment in future optionality, not really an immediate red flag. And looking ahead, their 10K filing talks about ongoing expansion of paid clicks, impressions, growing monetization rates, driven by AI and services, and that expanding cloud footprint. So continued top-line growth looks likely.
That makes sense, putting the other bets in that strategic context. Yeah. Okay, let's pull back the curtain a bit on how they actually fund all this. We talk revenue, but how's their cash management? What's their financial muscle like compared to rivals?
Oh, their financial health is undeniably robust. Alphabet consistently generates phenomenal cash flow. And that doesn't just fund the other bets, it enables huge shareholder returns through buybacks, like $15.3 billion in Q1 2025 alone.
Wow. Okay.
Now, they did issue $12.5 billion in senior unsecured notes back in May 2025.
Taking on more debt?
A bit, yes. Suggests a measured increase in leverage. But their overall debt remains remarkably low relative to their massive cash flows. They maintain healthy cash reserves and their debt capitalization ratio, comfortably below most tech peers. Points to a very low financial risk profile.
And competitively. We know they're big, but how solid is that position really?
It's not just leading, it's often dominant. Search, digital advertising, cloud infrastructure. Their advantages aren't just market share, though. It's that deep ecosystem. Proprietary AI and machine learning refining search and ads constantly. The ubiquity of Android on billions of devices. The sheer scale of their distribution channels, YouTube, search, maps. And these aren't static. Data from one product fuels the intelligence of another. It creates this powerful, self-reinforcing moat.
A moat? That sounds strong.
It's incredibly difficult for even mega-cap rivals to breach. Management expects continued pricing power, monetization improvement, driven by these core strengths.
Okay, formidable on paper. But then you look at rivals.
Yeah.
Microsoft pushing AI in Bing and Azure, Amazon's ad business growing. How truly unassailable is that position? Are those moats really impenetrable, or are competitors finding ways to, chip away?
That's the billion-dollar question, isn't it? And it's why they have to keep innovating constantly. Look, their position is dominant but not unchallenged. Microsoft is making strides in AI search, growing Azure aggressively. Amazon's ad business is formidable, leveraging all that e-commerce data. But Alphabet's scale and the way its services connect search, YouTube, Android, Chrome creates network effects that are just incredibly hard to replicate. When they roll out new AI features in search, billions see it almost instantly. Advertisers on YouTube tap into this vast, engaged audience. It's that continuous feedback loop between products and user data that makes their AI and ad targeting so effective. It constantly reinforces their leadership.
So it's dynamic, always evolving.
Exactly. Built on massive data and continuous algorithmic improvement, not static at all.
All right, let's switch gears a bit. For the chart watchers among us, after such a dramatic period, what's the technical picture telling us? What's the heartbeat of Alphabet stock looking like right now?
Yeah, that surge definitely left its mark. The technicals show a robust underlying trend, but with some expected short-term choppiness. Alphabet Class A shares, GOGL, traded roughly between $197 and $203 in August and September. There was sharp volatility around the July earnings report, too.
Key levels to watch.
Right now, look for support around the $197 area. Resistance seems to be forming between $205 and $210.
Okay, and for those maybe less fluent in chart speak, indicators like moving averages, RSI, what do they tell us about the stock's health and momentum? Are they flashing warning signs or green lights?
Good question. Think of it like a car's dashboard. The 50-day simple moving average, or SMA, is trending nicely above the 200-day SMA.
Which is bullish.
Classic bullish signal, yeah. Indicates the medium-term trend is still upward. RSI readings, relative strength index, they're in the low 60s. A bit warm, maybe mildly overbought, but not stretched into extreme territory that screams imminent reversal.
Okay.
And the MACD, another momentum indicator, that remains positive, supporting the uptrend. So yeah, there's increased short-term volatility post-earnings, maybe some insider activity we can touch on, but the overall trend momentum still looks upward. The engine's running well, even with a few bumps.
Okay, that paints a pretty clear technical picture. Now, looking forward, we have the regulatory relief, Strong financials, bullish technicals. What are the key events or potential bumps in the road investors should have on their radar?
Definitely some things to watch. Short-term catalysts. September 15th, there's a dividend payment. Early October, you'll have ETF and index rebalancing. That can move the stock as funds adjust holding.
Right, technical flows.
Exactly. Then late October is Q3 earnings. Huge focus there will be on Google Cloud margins and, crucially, how that AI ad monetization is tracking.
What else?
November brings updates on holiday season, ad spend, always a big one for Alphabet, and also the 13F filings from big institutions. Gives you a peek at what the smart money is doing. Plus, you've got ongoing product launches through Q4 AI, cloud, hardware like Pixel, Gemini AI updates. Those can generate buzz. And continued share buybacks could offer technical support.
And longer-term catalysts.
Really, it's about the expansion of Gemini and other AI-powered features. That's expected to drive significant long-term monetization, margin expansion, fundamentally reshaping services and cloud. Those are the big, enduring growth drivers.
But no company, even Alphabet, is risk-free. Even after the recent legal win, what are the main risk factors that could still impact things?
Absolutely need to stay prudent. Despite the win, regulatory scrutiny isn't gone. Antitrust, privacy, these still pose material risks. While they avoided the breakup, those behavioral remedies could evolve or new complaints could emerge in different places that could impact future profits or the business model.
Okay, regulatory overhang isn't zero.
Not zero. Competition is another constant. Amazon, Microsoft, Meta, they're tough rivals in cloud, ads, AI. Their strategies could pressure Alphabet's margins. Then there's execution risk. Those other bets, big R&D projects, not all moonshots land successfully.
True.
And then broader market stuff, tech sector volatility, interest rates, the economy impacting ad spend. Those macroeconomic factors always play a role.
We also saw some insider activity, CEO Sundar Pichai selling shares. That often makes investors nervous. What should we make of that?
Yeah, that's a common concern, but context is key here. Pichai and director Francis Arnold did report sales from June through August. For instance, Pichai sold about 32,500 shares on August 20th. But these are almost always routine sales under prearranged Rule 10b-5-1 plans.
Ah, the planned sales.
Exactly. Insiders set these up way in advance to sell shares periodically, often for personal financial management or diversification. It avoids any suggestion of trading on non-public info. It's rarely a sign of lack of confidence, more just, planned liquidity. Market sentiment overall, still moderately bullish on Alphabet. People like the AI story, but are wary of general tech volatility.
Right, that makes sense. So, okay, we've dissected the legal win, the strong financials, the competitive moat, the technicals, the risks. Bringing it all together, what's the verdict? Is Alphabet a good time to buy now? What's the overall sentiment from the sources we looked at?
Based on everything we've reviewed, the overall rating comes in at a strong 8 out of 10.
An 8 out of 10. Pretty positive.
It is. The rationale boils down to those key strengths: exceptional financial health, that industry-leading competitive position, strong recurring revenues, top-tier cash flow, and those aggressive buybacks supporting shareholder value. But again, balanced against the risks, that heightened regulatory environment, even post-ruling, potential sector volatility, and the intense competition.
And valuation. Does it seem expensive after that run-up?
It does trade at a premium compared to some tech peers, yes. But that premium is often seen as justified by its growth, its profitability, and the sheer strength of its balance sheet.
So what kind of investor is it best suited for? Long-term hold, short-term trade?
Unequivocally, this seems best suited for a long-term investment. Why? Because of that dominant industry position, the robust financials, and those transformative AI growth drivers. That's a multi-year story. Now, could you trade it short-term? Sure. Momentum plays around earnings, product launches, that's viable. But it's much more exposed to sector swings and unexpected news. Higher risk, more speculative.
So Alphabet's clearly riding a significant wave of momentum, favorable regulatory outcome, record highs, sustained earnings growth. Seems strongly positioned.
Which leads to, I think, an important question for you, the listener, to consider. As AI becomes increasingly central to Alphabet's whole strategy, how will its ability to innovate and monetize these advancements be balanced against that ongoing, evolving landscape of regulatory oversight? Especially after this recent legal win, will this victory sort of free them up to accelerate even faster? Or will those behavioral remedies subtly constrain their path forward? It's a key dynamic.
That's a really powerful thought to chew on. Your perspective on that balance innovation versus regulation could be absolutely key to understanding Alphabet's journey in the coming years. Well, thank you for joining us on Investing Talk podcast. We really hope this discussion has provided you with some valuable insights. Don't forget to subscribe, like, and please leave a comment. Tell us what you think, or maybe suggest a company you'd like us to analyze next time. We'll be back soon with another exploration into the world of investing.